A tax treaty is essentially an agreement between two countries. Therefore, there is normally no possibility of a tax treaty between, for example, Belgium and Delaware. This agreement between two countries deals with tax consequences resulting from various situations that may arise as a result of the fact or action of a natural or legal person. For example, what happens if an individual residing in France earns copyright income from a U.S. company? Are copyrights taxable in the United States, France, both countries, or neither country? The purpose of the tax treaty is to resolve these types of issues. This means that a tax treaty may, in effect, change one or more provisions of the tax law of either of the two countries concerned. On the other hand, since states are not parties to any tax treaty signed by the United States, they have no obligation to comply with it. Tax treaties only bind the U.S. federal government and other signatory countries. Finally, here are 3 points you should remember. Point 1. According to accountants and tax experts, your U.S. corporation generally has to file a tax return, at least at the federal level, and pay taxes in the United States on its worldwide income. Even if it does not have a physical establishment in the United States, even if it does not do business on U.S. soil, and even if it has no shareholder, director, officer, or employee in that country, your corporation must still file a U.S. tax return on its worldwide income. The tax situation of your LLC may be different, often even advantageous. But this can depend on many factors. A tax specialist or accountant specializing in U.S. taxation will be able to provide you with adequate information on this subject. Point 2. If you want to physically establish your company's operations in the United States, there is not necessarily an ideal location. Each state has its advantages and disadvantages. Before choosing one state over another, you must analyze everything, not just the tax rate or the sales tax rate. A multitude of factors must be considered before making your choice, including the following: availability of manpower, land, rail, and air transport facilities, proximity to customers, proximity to suppliers and subcontractors, quality of life, subsidies, and taxation. There are several companies that offer professional analysis and location research services in the United States. Point 3. If you create a corporation in the state of Delaware and it has no physical presence, it generally does not pay any taxes in Delaware. However, if you create a corporation in the state of Florida, it must file a tax return in Florida simply because it was created in that state. Often, the best choice for companies planning to operate virtually or have multiple offices in the United States is to create a company in the state of Delaware.